We are now doing part H of SAICA paper 2, first board exam, previously known as ITC. It's now called IAC. What we do when we're doing our paper, we start reading what's required it says or wants from us. Then we go summarize the scenario, then come back and look at the suggested solution together. Part A says prepare all the journal entries necessary to account for all aspects relating to the solar panels. In French cards, FY 2024 financial statements. Ignore all forms of taxation. Dates and journal narrations are not required. Round all calculation to the nearest rand. Just to summarize the required to want us to consider all experts. That means all journals that we believe should have been recorded in the books of French card we need to consider. So what will be those journals? The journals that we should consider should be the journal to acquire the asset, consider all the necessary cost to bring the asset to the condition and location necessary to be used by management, consider the depreciation. If there's anything said about impairment you need to think of and record it. So we start without wasting time, let us now go and see what the scenario says and which section of the scenario had this information about the purchase of solar panels. If you go to our scenarios, we can see that the purchase or acquisition of solar panels was part 6 of our scenario for this paper. Let us read all together, understand, and then go back to the suggested solution and summarize it as well. So what happened, French card, we all know that they wanted to move to eco-friendly environment. And one of the things that they said they were going to do was to have solar panels or use solar panel as opposed to using electricity. So they believe that will help to save the energy for the country. So now they then said they purchased 10 solar panels. And then the decision to place the order was on 1 February 2024. And then they said the lifespan of the solar will be 40 years. And then they said this lifespan is greater than the one that are purchased in South Africa by 20 to 30 years. So that basically means the solars purchased in South Africa, they are roughly 10 to 20 years, not more. So what they did, they went to purchase this solar in China. Supply is based in China. And then the purchase price is 1.3 million and it was quoted in USD. They made a deposit of 50% on 1 March 2024. And this is the date when control was passed to French Card SA. And then on arrival in Durban, on 22 March 2024, they paid the balance. So the balance was then paid when the solar panels arrived in Durban. Moreover, the purchase price of 1.3 USD, they had to pay the shipment cost of 1.1 million. This one is quoted in SA rand. We do not have to convert it. However, when it comes to 1.3 USD, we have to convert it and we need to understand when we should convert this amount. And then, additional to that, they incur non-refundable import duties or customs worth 2.6 million. So just to let you know what are customs are tax when you import goods to South Africa. So that's the amount they paid, and we are told that it is non-refundable. That means they aren't going to get a refund in the future with regard to those custom duties or those import duties. Moreover, the above 3 costs that is discussed already which is transportation, the customs, as well as the purchase price. They incur the transportation cost in order to distribute the solar panel, and it was worth 750,000. The solar panel had to be installed, and they were installed at a cash cost of 1.2 million. After the installation, they need to run tests to see they are working effectively and in line with the SA laws and rules, and they incurred 200,000. Then, on 1 May, they were happy that the solar panels, after the test, they are working as intended by management. And then they celebrated the milestone through the event at a cost of 153,750. That was on 1 May 2024. And then they discussed that the residual value after 40 years will be 20% of the total cost. Then they said they will depreciate this solar panel on a straight line basis. The exchange rate we provided, it's on different days. We're not going to need all this exchange rate. However, to trick us, we have been provided all this exchange rate. So we know all this day to what was happening. So the first part is when they placed the order. The second part is when the risk and reward was transferred and the 50% deposit was paid. And then the third one, it when it reached Durban and the balance of 50% was paid. And then 1 May, when it was brought into use or it was available for use. All these data were provided, and the USD to ZAR rates we are provided here. However, we basically do not need all this rate. The rates that we need when the risk and reward was transferred in order to convert the USD amount into rand. We also need the 22 March 2024 when we paid the balance of the 50% deposit, because now, since the rate went up, it means that we are going to pay more than what we paid for 50%. It means now we have FEC difference that we need to consider. In this case, it will be FEC loss because the rate went up from 1 January 2020, from 1 March 2024 to 22 March 2024. Let's look at the solution and analyze it together. So when we're looking at the solution, what we're going to do, we're going to start by looking at the calculations. Then we move to the journals. So what happened in our calculations? When you look at our calculation, it says other cost. And then because our total value of the solar panel when risk and reward was transferred, it's 18.79. We're going to say 1.3 times 18.79. Why are we using 18.79? Because that is when control passed to us or passed to French Card. And the rate at that time, it was 18.79. That will give us this amount of 24,47,000. And then the other cost that we need to consider in order to get the final value of the solar panels. What will be those costs? It will be shipment cost, import duties, transport cost, installation, and testing. One will ask, why are we including the import duties? The reason we have to include the import duties, it's because we were told this is non-refundable. If it was refundable, we were not gonna include it. But in this case, it is a non-refundable tax, then we need to include in our determination of the cost of the solar panels. And then the other one is straightforward. It's shipment cost, it's transportation cost, it's installation and testing. So all this cost we need in order to bring the solar panel to the condition that is intended by management. It is for that reason that we're going to have to accumulate all this in order to get the final value of 30 277,000. Then once we have all this amount, we add all of them together and then we get this amount. Now that we have this amount, we have to also remember that because the 50% deposit was paid on 1 March 2024, we had a balance of 50% deposits that were paid subsequently on 22 March 2022. Because of that reason, we incur an FEC difference, which is this case, it's a loss because the rate went up. We are making assumption that they did not fix the rate at this amount. Since the rate was not fixed, we have to pay the FEC difference or Forex difference loss. So what is that? FEC difference is going to be the rate that was when the risk and reward was transferred and we paid 50% deposit, which is 1 March 2024. And then the second rate will be the rate when it reached Durban Harbour and the risk and reward had already been transferred. However, it was only at that point that we paid 50%. So we get this difference, we multiply by the total cost and multiply by 50%. That's how we calculate the FEC difference. However, you must take note that to get the initial cost or the total value, you aren't going to consider this amount, the FEC difference, but we need the FEC difference for our journals, but it's not going to be considered in the cost of an asset because this cost, it happened subsequent to the initial purchase, which is the date when the risk and reward was transferred. Then the last journal that we're going to have to pause, it will regard to the journal. Now one will ask, why are we using 8 months? Why aren't we using 12 months? The reason we're using 8 months is because these solar panels were ready and available for use only on 1 May 2024. That is when they made a celebration after they concluded the testing of the solar panels. So if we count from May to December, that gives us a total of 8 months. And then others will come and say, why are we using 40%? They want to understand 80%, sorry. Why are we using 80%? Why aren't we using 100%? We are using 80% because we were told that the residual value or the value that they believe the solar panel will be worth after 40 years, it's 20%. So we need to subtract 20% from our 100% and come up with 80%. Now, this value is what we've calculated here. So I believe no one will be asking where is it coming from. Then the depreciation that we'll need to journalize, it will be 403,693. So now one will ask, what journals am I going to be passing? Now let's go up and see the journals that we need to pass. If you go up, the journal that we need to pass, it's the entertainment cost. The entertainment cost because the asset was already in the location and condition to enable the management to use it. It is not an accumulative cost, a cost that we need to add to determine the value. And you can see they were just celebrating now that they are closer to attaining the CEO's wish of moving to eco-friendly environment. So this entertainment cost will be expensed at 143,750, and that is the amount that were given that they had spent on 1 May when they were celebrating that the solar panels were working well and effective. Right. So we are fine with that. And then after this one, I want us to move to alternative 2 because alternative 2 will be much better for you to understand, right? So if we move to alternative 2, we have solar panels, and the solar panels is the amount that we calculated below of 30,277,000. This is the amount that we have here. And then the Forex expense, it is an expense as well. Then we have it here. Then we have the bank. So there's a total amount that they have incurred for those 10 solar panels when we exclude the amount that they incurred for entertainment. So they say this is the recognition of initial cost. I want you to take note that this is an expense. It's not included in the solar panels. The FEC difference, it is an expense. It is not included in the solar panels. Don't look at it because it's generalized together with this amount and say, oh no, that simply means it is included in the cost of the solar panel. It is not included. It is a separate cost and it is an expense. However, the total value that we calculated here, it is what the solar panel costed us or what we can accumulate to the asset value per International Accounting Standard 16. And then the last journal will be our depreciation for the year of 8 months and accumulated depreciation. And then this is the recognition of expense or depreciation for the year. So the journals that I recommend for you on my side would always be this one, where we're looking at the entertainment costs that we incur when we're celebrating, and then this one where we are recording the expense, recording the cost of the solar panels and the bank, and then the last one is depreciation. However, one might say, okay, I want to see the breakdown. So remember the breakdown, it has different initial cost. So we had the first different cost. So there is a first one where we paid 50%, and then there's a second part where we paid another one. So if you look here, for the solar panel, which is just the full cost, we have of 1.3 USD. The total when converted to SA Rand, it's 2447.00. However, we know that we paid 50% for the first when the risk and reward was passed and it was put into boat, and then the other 50% when it reached the harbor. So for that reason, if you see here, we are considering the initial cost or the initial occurrence of just the full 1.3 USD. So that's the full cost. It basically your 1.3 times 18.79, which is the cost when risk and reward was transferred on 1 March 2024. And then the second part will be the creditor, which is basically 50% of this amount. And then the other part is bank. Why are we separating the two? Because we're told that the first 50%, which is bank, was paid on 1 March 2024, and the balance of 50%, which is currently a creditor, as on 1 March 2024, it was paid on the 22nd of March 2024. So this is merely or basically looking at the recognition of 1.3 million USD. Then the second part. Now, the second part look at the additional cost, right? And then the reduction of the creditor as well as FEC. So now why is it looking like that? So the first part is that remember that here we had recognized the creditor. So now we have to write off the creditor because we would have made payment on 22 March 2024. And then this one is with regard to the FEC that we incur, which is a difference between 18.79 on 1 March 2024 and 19.60 on the 22 March 2024. So it's basically the difference when we paid the first deposit and when we paid the second deposit, or when the risk and reward was transferred and when the last 50% was paid. Then this solar panel part now is the one regarding to all the other costs that we incurred, which is your transportation cost, your installation, your testing, your non-refundable taxes or customs, as well as the shipping cost. So that is the cost that we're looking at now. And then the total come to 8590. So I was doing this part for the interest of people that will say, I honestly wish to understand how they went about this one. So we're looking at alternative one. The first part accounts for the creditor and the 50% payment. And then the second part accounts for the write-off of the creditor that was recognized here, the other costs that were incurred for the solar panel, and the FEC difference as a result of delayed payment of the 50%. So now if you look, we have covered everything, which is first calculation and then journal. So how you would have went about this on the exam is that you should have started with the calculation and then moved to your journals. Now, I like us all the time to look at what mistake you would have done here when we're looking at this paper. So the mistake number one, you would have missed that the cost of the solar panel was quoted in USD. Instead of converting the 1.3 million, you would have made an error by not converting the USD amount. So that would be the first error that you would have done. And the second error you would have done, you would have not included the customs, because you will think, because taxes maybe are refundable, so you don't have to consider. However, you have been told in this case that the taxes these customs are not refundable, meaning to say we have to add it on the value of our asset, because it is a cost that is needed to be considered in order to have this asset ready to be used as intended by management. What other cost you would have missed? Potentially, you would have missed testing cost. You would have said, no, this is not the cost that I need to bring the asset to the condition as intended by management. However, you do actually need the testing cost, because the solar panels, due to its nature, it has to be tested before it put into use, because if it is not tested, it is connected to the electricity, there is a lot of disaster that might arise as a result of not testing the solar panel. The other error that you would have made is to include the entertainment cost of 143,750, because in your mind you thought that is also a necessary cost, when it's a cost that was incurred post realizing that now the asset is as intended by management. And moreover, IFRS 16 dispute recognizing the cost of this nature. What other error you would have made? Instead of excluding the residual value of 20% when calculating the depreciation, you would have included the residual value. The other errors you would have made, you would have decided that you are using the wrong or the incorrect rate. That is, maybe to use 1 February when the order was placed instead of when the risk and reward was transferred. You would have potentially missed the FEC difference. There's a lot of errors that you would have made depending on how you were thinking on the day of the exam. So what I want you to do when you're going to those exams, to those that are writing SAP, I want you to be very calm. And when you get there, just thinking of yourself that after this exam, I'll be writing APC. That what I want from your side. Feel like that you are going to be writing APC after this exam, and in that way you are standing a better chance of passing. If you're calm in the exam, you are most likely to pass than not. And the reason that I want you to be confident and calm is because you have gotten this far and it was not easy for you to get here. So now that you are here, be so confident that you stand a better chance of finishing this exam and going right a PC, and then subsequently reach the final milestone, which is you becoming a CAC. All the best for making this far. I wish you all the best in your upcoming SAP, or for those that are listening to this video that are writing the January exam next year. All the best. Can you please do me a favor? Share my channel, subscribe so that we can increase the community. My TikTok account, it's economics199. Same with my red app account, it's economics199. Thank you. Bye bye.